Coming up today, stocks unable to bounce as fear sinks in. Microsoft cancels data center leases. Apple's huge investment. Is Buffett waiting to buy the dip? And why the economy depends more than ever on rich people. It's the start of the new week, guys. Let's have a good one. And welcome back, everybody. Once again, the market is soft here to start the new week off. Did have a little bit of a bounce in the morning, but that was lost straight away. With the Magnificent 7 leading the way down, actually losing a bit of support there on the MAGS ETF today. And just looking at the S&P 500, we also lost that 6,000 handle today, 59.83. As I said on Friday, not quite there yet on my S&P 500 oscillator. Still around 44. Has to go below 40 for it to give us that oversold signal that the market may have found a low. And looking back, it is pretty good at timing short-term lows. Back there on the 20th December, the 5th of August, and the 17th of April, it does have a pretty high win rate, accurately nailing the low. So we could still have a bit further to go. May actually come down and test this low from the 3rd of Feb, which is about 59.25 on S&P. And that's probably when my oscillator would go into oversold territory, because we do have quite a bit of weakness up the front there across the board. But once again, a clear defensive rotation. You can see that in sector breadth. The percentage of stocks above the 5-day MA, staples, health, REITs, and utilities really getting a bump up again there today, whilst the growth sectors continue to come off. And we can see that in the spread between high beta stocks and low volatility stocks. Got slammed down there on Friday, off 3.6%, down another 2% today. So a bit of heat coming out of this market, a bit of a defensive rotation, got a few negative headlines. Market likely a little bit on edge as we go into Nvidia's earnings on Wednesday afternoon. Stock coming off a bit hard again today as well. We've also got bond yields coming off as we go into PCE inflation this Friday. Got the 2-year there at 4.17, and some other hot stocks of late continuing to come off. Palantir losing its 50-day VWAP today, and I could have held that hedge trade for a few days longer, no doubt, as that big buy the dip candle did indeed lose its low today, and we may be coming down to close that earnings gap after all. And just going out to a monthly chart, that's not looking too great. Bit of a shooting star pattern here. Like I said, when these hot stocks come off, they can come off quickly. Just moving on to Tesla, as I thought, coming back down to test these lows. Pretty much bounced right off there today at 325, but once again, not a really convincing looking bottom there. Only -9 on the DSI. That's not really a deeply oversold condition, and typically with Tesla, they can have these little mini blow-off tops and capitulations before it does find a bottom and top. So I wouldn't be surprised to see this trade down into the low 300s, and who knows, maybe he has to hit a 2-handle before we do find a bottom. But just looking at what's spooking the market today, we got news over the weekend, Microsoft cancelling some data center leases as they begin to scale back on data center spending. However, that's their headline. If you read the detail, this is something they were really short on going back 3-4 years ago. They said it themselves, they're short on power and space, so they did a lot of catching up. But nonetheless, I think that helped to contribute mega cap tech coming off somewhat there today. Even the previously hot Meta losing its 50-day. Still lingering concerns about inflation and even stagflation. That's when we don't have any economic growth, but we've still got inflation. With the prevailing narrative that tariffs will materially contribute to upside inflation. Similar rhetoric coming out of the Federal Reserve. And this in addition to Buffett's huge cash reserves. Maybe all contributing to a bit of fear in the market. Actually not that far away from hitting the extreme fear zone, fear and greed index. But a reoccurring narrative throughout the market, something we've seen on a few Mondays before actually. There's news coming out of the greatest investor of all time, Warren Buffett, with his annual meeting over the weekend, in which it was revealed Berkshire has a record $334 billion in cash. Once again, most people fixated on that absolute number instead of comparing things relatively. But the prevailing consensus is that Buffett's waiting to buy the dip, and all the businesses he owns collectively are doing well. Hence why we saw the stock close at a brand new all-time high today, up over 4%. Market cap almost 1.1 trillion. But just to make a bit of a counter argument to the online consensus that Buffett's hoarding cash, waiting to buy the dip, before talking about his latest points, in which he actually doesn't say why he's holding all that cash, just keep in mind, nobody knows better than Buffett that cash and T-bills are the worst performing asset over the long term. It's been shown time and time again. He has no material edge in timing the market, and that's why he said his whole career he doesn't attempt to time the market, even though everybody online is now saying that's exactly what he's trying to do. However, history would suggest he's loading up his elephant gun, as he likes to say, getting ready for a large acquisition, which I think he wants to go out with a bang. A signature acquisition. And before we speculate what stocks he may want to take over, just looking at some of his recent comments and his latest shareholder letter, he pointed that most investors out there are too focused on his stock portfolio, which is less than a third of his company's value, where they maintain near or total control of 189 subsidiaries. He went on to say, despite what some commentators currently view as an extraordinary cash position at Berkshire, the great majority of your money remains in equities. That preference won't change. While our ownership has moved down last year, the value of our non-quoted controlled equities increased and remains far greater than the value of the marketable portfolio. That means the businesses he owns outright. That value's gone up, while his publicly traded stocks portfolio has gone down due to selling. And that's because he's found putting some money in bonds at 5% is not a bad idea. Because when he looks around, it's not easy to find a premium on top of that for the businesses that he can acquire. And no doubt a dip in the market could actually help him fire off his elephant gun. But in my opinion, and this is just my speculation, he's indicated he's going to retire soon. I'm not sure if he wants to go out with record all-time cash, or does he want to go out with the bang, his biggest acquisition ever, and put half or more of that cash to work, just like he has a track record of doing his whole career. And so if he does take over a stock, it's probably one he already owns, some of. I would say the most fitting would be his favorite stock of all time, Coca-Cola. As a kid, he used to go to Charlie Munger's grandfather's store, buy Coke bottles in bulk, and sell them individually at school for a profit. He's always had a long-held affinity for this company, and that's why he vowed to never sell them. And just looking at Coke's current market value, $303 billion. Berkshire has $334 billion. Of course, they would have to pay a premium to take out the stock. Buffett wouldn't want to spend 100% of his short-term liquidity. So I'm speculating he could be stockpiling cash. Who knows? Take out Coca-Cola. Wouldn't that be a headline? And completely flip this narrative that Buffett's kind of shorting the market by holding cash to wait to buy the dip, which, like I said, a dip in the market could allow him to do this. But as Buffett has said many times, he doesn't attempt to time the market. VC is a good investment. He doesn't care about the market, the economy, or anything. He's an old school kind of discounted cash flow valuation guy. VC's the yield on a potential investment a lot more attractive than what he can get in short-term bonds, then he'll pull the trigger. So again, if interest rates are going to come down, that's just going to make him more likely to make an acquisition. It may not be Coca-Cola. Some of his other long-held favorite stocks, American Express, a bit over 200 billion market cap. Bank of America, Chevron would be a big one, 283 billion market cap. He's known to like energy businesses. Oxy could definitely be one, same with Moody's or Kraft. But for Buffett, I would think the most poetic would be Coca-Cola. If he could take out that and put it on the books of Berkshire, that would definitely be his signature move of his career. But anyway, I guess we'll just have to wait and see, not if, but when he puts a lot of that cash to work, which I think there's a good chance he will before he retires, barring any surprise health conditions, which at the age of 94 is definitely a real chance for sure. But hopefully not. Hopefully he can hang in there for another year or two and go out in style. But nonetheless, that headline and narrative does reverberate amongst investors and understandably makes them question the market if the greatest investor of all time holds that huge number, $334 billion in cash. Not to mention the headline of Microsoft deaccelerating their data center spend. I think overwhelming all that, in my opinion, is the biggest stock in the world, earmarking $500 billion for US expansion. Apple going to create 20,000 new jobs, build a factory in Houston to support its generative AI system. That's a pretty big deal and a lot of money, really driving the resurgence in modern day US manufacturing and onshoring of production, continuing their move and diversification away from China. Also saying they wish to support US manufacturing on the whole, becoming a bit more patriotic of late. And there's a look at the stock today, holding up the best out of all mega cap tech. And again, these are just big numbers. Ever since the new admins got in, even the weeks leading up to it, we've had deal after deal being announced. Cumulative trillions of dollars of new capital set to be invested in the States. However, we've still got the domestic Russell 2000 fund actually trading below the lows of the day prior to the election. Got that massive gap up the next day. But the broader market's kind of been stumbling since then. And we are somewhat at a bit of a support level right here on the Russell 2000, which I would say is a little technically important. If we were to lose the support zone, that could potentially change the structure of this kind of uptrend we've been in for the last year or so in the Russell, or at least weaken it, setting us up for a bit more consolidation. The further we push away from highs, the longer it inevitably takes to get back. However, maybe the market's close to finding a bit of a short-term bottom here as well. We do have good fundamentals to supported by the dip. Yields have been pulling back, oil's tame, GDP holding up, had a pretty good Q4 earnings, unemployment rate still around 4%, credit spreads low, things are relatively healthy. Like I said, we're still in the midst of the biggest capex cycle, potentially of our lifetimes. And for everything that's going on, the VIX is relatively tame. Briefly touched 20 there today before coming back, but the market is still a little fragile. These Monday morning gap downs, a lot of dispersion underneath the hood. But again, high yield bonds, which are really sensitive to risk on sentiment, aren't really throwing off any warning signs here in the price action. One proxy for liquidity and sentiment though is definitely a little soft. Crypto, Bitcoin, did just get news on Friday, the biggest hack ever. $1.5 billion coming out of Bybit. And unlike traditional finance, in crypto, once it's gone, it is gone. Who knows who has all those coins now. Anyway, Bitcoin as well, just like the Russell, testing a bit of a support base here, 92,000. Ethereum as well, didn't manage to get up to its 50-day, turning back down, testing this big buy the dip wick Along with the canary in the coal mine, MicroStrategy, now known just as Strategy, also taking out some recent lows, as the head cheerleader himself continues his nifty little trick of selling convertible bonds to the market and plowing it all into Bitcoin, helping to get his dollar cost average as close to all-time highs as possible. Whilst he goes on media all day saying things like, Bitcoin can go from 100,000 to 1,000, the debt is not going to get called, there is no recourse, which is pretty much flat out a lie. Just as this hedge fund manager pointed out today, convertible bonds are debt securities that have to be paid off in cash if the stock price is below the conversion price. Your investors will still want good old-fashioned fiat currency if it's worth more than your stock. So it's pretty simple. He's been selling convertible bonds with 0% coupon, meaning you don't earn any interest on it. And if the expiry date, a couple of years from now, whenever, if the stock's above the strike, bondholders can convert it into stock. It's obviously a no-brainer. Just like if the stock's below the strike, you won't convert it. You'll want your principal back. However, as I've said, not if, but when Bitcoin has its next bear market, keep in mind it has a history of having between 70 to 90% drawdowns in its bear markets, it's highly likely the strategy stock is going to get absolutely smoked. And all these bondholders who could very well become bag holders will be scrambling to get their principal back because a lot of his fresh convertible debt is at strikes 500, 600 and above. And the stock's already down almost 50% off its highs, even though Bitcoin is only down about 15%. But like Ben went on to say, Sale is aware of this. He knows what he's doing. He's just speaking to an audience that does not. And that's why he's pumping it up, along with selling record stock himself at the same time. Pretty much the exact same thing he did back in 2000, for which he was charged by the SEC. Again, another guy who's had multiple run-ins with the law, tax evasion, you name it. But to many people, he's crypto Jesus. But let's see how much of a savior he is, not if, but when his stock craters 90%. Just like last time, he'll blame it on someone else, and he'll leave you holding the bag. So no doubt, a bit of a risk-off mood in the markets at the moment. Like I said, some of those key assets testing support levels, mega cap tech pulling back. Is Jensen Huang going to save the day this coming Wednesday night and blow out the numbers and, more importantly, guidance? I think a pretty good chance that he does. Because believe it or not, Nvidia's stock's actually been trading sideways for over 6 months now. Same price it was over half a year ago, as we go into what I would say is a pretty important earnings. Still didn't fully recover from that DeepSeek scare. Questions over Blackwell production. Are all the big hyperscalers still going to buy every single GPU they can? I know Elon Musk is with XAI. So I don't think he has a problem with his order book. I think once again, it's more a supply problem than a demand problem. But either way, this could really get the market moving in either direction. It could confirm everybody's fears of late, or it might pull a good old gotcha. And before we know it, we're ripping up to new all-time highs. And if you've been wondering, how does the economy and the stock market keep holding up while there's so many people struggling out there? Well, the fact is the economy has been changing a lot, especially over the last couple of years, really accelerated from COVID. That wealth inequality gap accelerated to an all-time high. In fact, it pretty much correlates really well with the Fed's balance sheet, wealth inequality. Of course, Jay Powell won't acknowledge that. The fact is now, the top 10% of earning Americans, that's households making about $250,000 a year or more, now account for 49.7% of all spending. Half of all spending coming from the top 10%. Everything from vacations to designer handbags. So cashed up Americans are still spending their money, something we've been talking about for a while. And it kind of reinforces it because they're mostly asset owners. Property and stocks. And so when capital markets hold up, they still feel like they've got cash to spend. Of course, that can go both ways. But this is unfortunately the effects from record government spending and Federal Reserve artificial money printing. It's inflated assets for the benefit of those at the top, paid for by those at the bottom. Their percentage increase in the cost of living much more than for those at the top. Even though the pace of inflation's come down, that embedded inflation is still very much there. Another interesting stat I saw out today, the number of federal workers in the states who are millionaires more than doubled over the last 4 years, as we're finding out more and more evidence of outlandish and even in some cases what appears to be fraudulent government spending, which has no doubt contributed to the inflation and wealth equality problem. And probably why overall consumer sentiment is still a bit soft. Moving on, geopolitics, still waiting for a deal on Ukraine, as I'd been speculating, might actually tie in with a economic deal with Russia, maybe something to do with oil, potentially pull Russia back into the global economy. No doubt controversial, but in my opinion, with the prior admin, they had us on a path to a global nuclear winter, or just another Afghanistan, 20 years of war, trillions of dollars, thousands of lives for nothing. But this has been a big dramatic change to foreign policy, forecast US defense spending, and Europe realizing they can't just rely on America for their own security, and American taxpayers won't keep paying for their security either. But interesting to note, even though it appears geopolitical tensions have been dialed down, we've still got one of the most sensitive assets to that, gold, trading at all-time highs. I've seen a little bit of weakness in the dollar of late, but is this the market hedging inflation? Maybe some other unknown risks out there? Silver as well, not too far behind highs, and oil still bumping around $70 a barrel, and a little bit of a pullback in agricultural commodities today as well. Speaking of which, retail traders will now be able to more easily trade commodity futures. CME Group bringing some micro contracts, just like they did for the SPE mini. Another way to help increase liquidity in the market. Hedge funds will help keep them close in line with the larger contracts, allows natural hedges, more granular trading sizes, and futures aren't really that popular with retail traders due to their size. So the more and more micro contracts we get, they will become more popular. And commodities are good for diversification. They can be doing a completely different thing from equities. And just moving on, looking at themed stocks in the market. Another sharp pullback for robotic stocks today. Once again, I added to my position in rich tech, as I'd been thinking we're going to trade down into the ones, and I'm happy to lower my cost average throughout this pullback. Same with Serve Robotics, dipping down here today, but on low volume, along with nuclear, a bit of a swift pullback. Battery stocks, space stocks, AI, biotech, data, quantum computing, and EV toll, and of course crypto. All the hot stuff having a bit of a sharp pullback of late. And like I said, we are sitting at some technical support levels on them, which if taken out could mean a little bit more weakness, consolidation, but still a possibility of a fake out as well, which the market's often good at doing because it knows people keep their stops just below prior lows. But like I said, what could really set the tune is this Wednesday night, Nvidia, along with PCE inflation on Friday morning. Those two things coming good, the market could find its feet quite quickly and we end up putting in a solid low. That's all I got for you today. Thanks for sticking with Click Capital, and I'll see you back here again this time tomorrow. Cheers.